You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Next, Airtel Africa, Aston Martin Lagonda, Haleon, JD Wetherspoons, and our US company of the week is PayPal. Sam, shall I kick us off with Next?
Yes, a favourite of the show.
Yeah, possibly our favourite retailer. I mean, battles it out with Tesco's, I think.
Certainly not B&M anymore.
No, absolutely not. Absolutely not. So Next had full price sales growth of 10.5% in the third quarter, well ahead of its own 4.5% guidance. And the better than expected performance was driven by a 38.8% growth in its overseas market, aided by increasing marketing spend, whilst UK sales were up 5.4% and also did better than expected. Fourth quarter sales growth guidance has been upgraded from 4.5% to 7%. That was driven by continued momentum overseas. Improved performance has seen full-year pre-tax profit guidance upgraded by 30 million to just over 1.1 billion, which would mark a 12.2% increase on the prior year. Based on achieving the current guidance, Next expects to pay a special dividend of £3.10 per share at the end of January 26. And the shares were up nearly 5.5% in early trading. In terms of valuation, Next has a market cap of £16.6 billion and trades 17.7 times forward earnings, compared with a 10-year average of 13.7, and it has a prospective dividend yield of 3.2%. I mean, I thought these results were incredible. I think Next continues to perform, and you think, how much more can it grow? It did look like it was, heading towards saturation point, or certainly I felt like it was heading towards saturation point in the UK. But then 5.4%, it's above inflation, and it's already pretty dominant. So that in itself is impressive. And then particularly now that you're seeing the overseas market growing too. And I guess that is probably the investment answer to where the future growth comes from. Obviously, that's still a small part of the business, but if they can continue to do that, then 17.7 times forward earnings doesn't look that expensive. I think for me, and having been burnt with retailers in the past, I'd be slightly apprehensive, even though Next is an incredible operator, just what the future will hold for it in the overseas markets longer term. I think you've seen lots of UK companies, for example, going to the US and not succeeding. And that's even with some of the best. So I probably wouldn't be buying shares in Next at the moment for that reason. However, I do regret probably when we started the show, and I basically was saying the same things, and then Next has had 5 years of fantastic results, and the share price has gone along with that. I do have some regrets there, I think, and probably, on that basis, it's not one to bet against. Sam, what are your thoughts on these results from Next?
Absolutely superb. We are used to seeing good results from Next, but even by Next's very high standards, these are outstanding, especially given the size. Yeah, I'm really, I don't know if surprised it's the right word, but I suppose I am surprised but Next is a business that's continued to surprise me. Last time we covered it, I was quite negative on the overseas growth and maybe some of the countries that was coming from. But the overseas growth actually accelerated in this quarter. So it's gone up from 28% to 38% growth, which is, just absolutely outstanding. And like you say, only 22% of total revenue, and that was for the latest full year, although if it carries on growing at that rate, it'll soon be a significant proportion. Yeah, just such an impressive business, the best retailer in the UK. I don't think there's really even a close second. The performance is fantastic, but I'd be nervous buying it at a forward PE of nearly 18. I think, like you say, that for us, it feels like the time to buy it was when we started the podcast. I actually think even if we'd been a bit slow on the uptake, which we sometimes can be with stocks like this, even if we bought it after 1 year or 2 years, we'd have probably still done very well. But yeah, it just feels like now I've kind of gotten used to seeing it at a P of around 10 to 14. So to see it at 18 as the business is getting bigger, yeah, I think with these results, you can justify it. And it really is such a good business. But I just wouldn't be comfortable paying 18 times earnings for a retailer.
Fair enough. How much would you be willing to pay for Airtel Africa?
Oh, well, that's interesting. And that is something that I will kind of cover actually as part of my review. So Airtel Africa, it is a favourite of the show. We both own it and we have been covering it for a few years now. So Airtel Africa have come out with their results for the half year ended 30 September 2025. For anyone who isn't familiar, Airtel Africa is a telecoms company which provides mobile data and services, including mobile money services in 14 African countries. And so, yeah, they have come out with their half year results, and revenue was up 25.8% to just under $3 billion. And all these figures are reported in dollars. Operating profit was up 36% to $959 million. Profit after tax was up 375%. Basic earnings per share was up 908%. Cash generated from operating activities was up 41.8% to $1.38 billion. And if we use the alternative performance measures, so these aren't the GAAP measures, EBITDA was up 31.5% to $1.447 billion. EBITDA margin increased from 45.8% to 48.5%. And the earnings per share, if you strip out exceptional items, was up 69.9% rather than the statutory 908%. And the operating free cash flow was up 46.5%. The total customer base increased 11%, with data customers growth accelerating to 18.4%. Smartphone penetration increased another 3.8% to 46.8%. With data average revenue per user growing by 16.8% in constant currency, primarily reflecting the 45% increase in data traffic across the network. Airtel Money is driving digital adoption and strengthening the ecosystem to advance financial inclusion. This is also evident in the acceleration in customer growth to 20%, bringing the total customer base to 49.8 million. Annualized total processed value for Q2 surpassed 193 billion, which was a 35.9% increase, reflecting both the expanding customer base and a strong focus on enhancing engagement through ongoing innovation. These efforts contributed to an 11% increase in constant currency average revenue per user. They've highlighted the rollout of over 2,350 new sites to a total of 38,300 sites, and an expansion of the fibre network by 4,000 kilometres to over 81,000 kilometres. This investment continues to drive increased data capacity across the region as overall population coverage reached 81.5%, an increase of 0.7% from a year ago, with 98.5% of sites being 4G enabled. They've said currency appreciation benefited reported currency performance, which is a nice change for us. And currency appreciation in Q2 has seen reported currency revenue growth of 29.1% versus 24.2% if growth was measured in constant currency. The constant currency revenue growth reflects the consistent execution of our strategy, supported by tariff adjustments in Nigeria and continued strong growth momentum in Francophone Africa. CapEx of 318 million was in line with the prior period, and the guidance for CapEx has been increased to between 875 and 900 million as they look to accelerate their ability to capitalise on the significant opportunity in their markets. They've continued with the debt localization program, and 95% of the operating company debt, excluding lease liabilities, is in local currency, up from 89% a year ago. Leverage has improved from 2.3 to 2.1x of EBITDA, with the lease adjusted leverage ratio also improving from 1x to 0.8x. And they've increased the dividend by 9.2%, and the $100 million share buyback program remains on track. They've said the preparation for the IPO of Airtel Money remains on course for a separate listing in the first half of 2026. And if we do break down the Airtel Money results a bit further, which they have now started giving out in more details as we get closer to that spin out, Airtel Money, which is basically kind of probably their version of PayPal mixed with a traditional bank, revenue for that division for the half was up in constant currency 30.2%. EBITDA was up 26.8%. EBITDA margin is at 51.7%, and the operating profit is up 27% in constant currency to 301 million. So that's operating profit of 301 million on revenue of 623 million. So nearly a 50% operating profit margin, which is excellent. CapEx very low, just 24 million. Operating free cash flow, 299 million. So again, nearly 50% operating free cash flow margin. And as we mentioned, customer base was up 20% to 49.8 million users. Total process value was up 35.2% in constant currency to 88.8 billion. And for the half, and the mobile money average revenue per user was up 11% in constant currency. If we split by region, for Airtel Money, total revenue 623 million. So just 4 million is currently coming from Nigeria, which is an expanding market. That is, I think, their biggest market for data and phone services. So hopefully that should be the potential to be quite a big market for Airtel Money as well. In constant currency, that market grew 142.9%, but is off a very small base. East Africa makes up 466 million of the 623, and 153 is Francophone Africa. In terms of customers, they've got 49.8 million, 2 million are in Nigeria, 38.9 million are East Africa, and 8.9 million are in Francophone Africa. In terms of valuation, if you were to just, well, because it is growing at quite a fast rate, so if you do a trailing 12-month PE ratio, it's maybe a bit distorted with the growth. Although I appreciate we did that historically, but that's when the PE was a lot lower, because it has done very well recently, so the PE is a bit higher than we used to. If you double those half-year earnings, which are excellent, you get a P ratio of just over 20, which I actually think is still pretty reasonable. One thing that's quite interesting is the market cap of Airtel Africa is just over £10 billion. If you were to annualise the Airtel Money operating profit, and I appreciate operating profit is not the same as earnings, but if we'll be a bit crude with it and just assume it is, if you were to annualise it and stick a 20x multiple on that, you would get a market cap for Airtel Money alone of 9.12 billion. Now, with those kind of figures and that potential for the market, you could potentially argue for a higher than 20x multiple. And that means you're getting the rest of the business, which is also very good, for $1 billion. So I think although we've seen a significant revaluation in terms of the multiple, I think you could still argue it's pretty cheap, actually. John, what did you think of these results? And is there anything you'd like to add from your recent boots on the ground research?
Well, yes, I think, first of all, fantastic set of results. It really looks like it's been helped by the currency, but also that sort of organic growth we've seen continuing. But when I went recently on honeymoon to Kenya, so market share in Kenya, I believe, is still about 90% Safaricom, which is owned by Vodafone. However, if you went back maybe 5 years, I think it was something like nearly 98%. It was absolutely dominated by Safaricom and Vodafone. Going there now, when you're driving along the motorway, it's Airtel Africa being advertised everywhere. You go to the airport and next to Safaricom, it's Airtel Africa. And I think they're going really aggressively with the pricing, undercutting Safaricom. And essentially, you're seeing the market, the shift to Airtel. And I think one of the other things that I learned when I was over there was that in terms of the market and the regulation, that has changed. So whereas Safaricom essentially used to have a monopoly on it, because if you had a Safaricom number and you had a Safaricom essentially money account, you could only transfer money to other Safaricom users. And I believe in Kenya, at least in the last couple of years, that has changed. So basically, the regulation is such that you have to be able to transfer your money to other providers, and the other provider, being the beneficiary of this, has been Airtel Africa. So that means that you're able to transfer across or transfer money to someone who's on Airtel Africa, as opposed to just the Safaricom that you used to be able to do. So Airtel's clearly been the major beneficiary of that. And I think probably with the operational know-how of Airtel in India, they've been able to transfer that to what is another emerging market. The other thing that was interesting is that when we were out in Kenya, it was essentially a safari holiday. and you would go into very small villages and there'd practically be sort of tribes around, and usually someone would have a mobile phone and they would essentially have a Safaricom account, and therefore money could be transferred to them. The previously sort of unbanked communities of Africa are coming into it. But you felt that really, even then, it was so unsaturated still. And I think one of the limiting factors when I'd spoken to people there was more getting data and the mobile signal. But I think when we've covered, the main part of Airtel in terms of the infrastructure, that is constantly being expanded. So I think once that improves, the Airtel money essentially goes with it. And I think there's still huge growth ahead for Airtel, particularly when you consider its market share in quite a few African countries isn't that big, and they're able to be essentially aggressively taking market share from Safaricom, or which is part of Vodafone, in addition to just expanding, in their own right to many of the unbanked population in Africa. So I think it's absolutely fantastic. I completely accept what you say about the valuation. And even though we've had a big run up with a share price, it's still not hugely expensive. And it'll be very exciting to see what Airtel money does fetch at the IPO.
And if anyone would like to fund any further boots on the ground research trips for the Investor Way podcast, please do feel free to get in touch.
Sam would also like to go on safari.
Absolutely. Airtel Africa still have 13 countries that John hasn't been to yet. So yeah, should we move on to a business that's not doing quite as well?
No, I mean, if anyone would like to fund some market research into an Aston Martin, that is also welcome. But Aston Martin Lagonda, the Q3 results out, and revenue fell by 27% to £285 million in the third quarter, as deliveries in the period dropped by 13% to 1,430 vehicles. Average selling prices fell at a faster pace of 20%, reflecting a sharp drop in sales of its high-priced special models due to production delays. US tariffs and weak demand in China also weighed in on performance. Free cash outflows worsened from £81 to £94 million, whilst net debt increased by 14% to £1.4 billion. The group expects to deliver around 150 Valhallas, which is their new supercar, in the fourth quarter, compared with 2 Valhallas in Q3. With that figure expected to rise to around 500 in 2026. 2025 total deliveries are expected to decline by mid to high single-digit percentage compared with the prior year, which was 2024 and 6,030 cars. Full-year underlying operating losses are expected to exceed £110 million. And the shares are actually up nearly 1.5% in early trading. In terms of valuation, Aston Martin Lagonda have a market cap of £637 million and trade at 0.39 price to forward sales, compared with it's not really a 10-year average, but an average since listing of 1. I thought these results were really poor. I suppose we have got used to this. And I suppose you look at the Valhallas, and actually it has improved a bit, but it's still pretty dire. They're continuing to burn through cash. On the topic of the Valhalla, only 50% are forward sold. So you do wonder how much they're going to have to slash the price on those new supercars. There are issues with tariffs. And it's a company that's been, I think, gone bust 9 times in its history.
I thought it was 007.
Oh, it might be. It could be 7. It's high single digits, Sam.
Not be 7 for much longer.
It's not going to be 7 for much longer. And I think, I love the brand, but as a business, it's just not working. And you do wonder at what point they are going to sort of go into administration. So, I think it's uninvestable. I don't really know what they can do, whether anybody would be capable of turning this around, but it's certainly pretty dire at the moment, I would say.
I would agree. I'll start by saying it's uninvestable. So there's not really any point looking at the valuation, but it is an interesting business to cover. I do remember last time we covered it, I think we've never been keen on it in the whole time we've covered it. But I think last time they were having some serious problems. And basically everything was resting on the Valhallas going perfectly, which it hasn't.
Yes.
I don't think it would have been difficult to predict that it wouldn't. But yeah, like you say, not forward sold, revenue's dropping, tariff, there's just so many problems. And they needed this perfect launch of Valhalla, and they made 2 of them. So it really couldn't be much worse, unfortunately. I'm sure someone will buy it. Someone has the brass 7 times. So I don't think it's going to be the end of the Aston Martin brand, but I can't see it being successful as a standalone company. I think the only sort of supercar brand that I'm aware of that has actually succeeded to that level as a standalone is Ferrari. And I think a lot of the others, they kind of sit within larger companies. And I think that's probably would be the best place for Aston Martin to end up at this point. But I suppose at least it is, the fact that this has been able to be listed and relisted so many times, it's probably a good example that markets are not efficient.
Yeah.
Because this could well come back on the FTSE at some point. I know it's still on for now, but I'm assuming it's going to go bust. But we could see it again.
So the last time it came onto the FTSE back in 2018, when it IPO'd, it was trading at about £40 a share, and now it's 62 pence.
I think it's overvalued.
I thought you might say that.
I'd short it before I bought it.
Yeah. And you're not someone who would short very much.
No, if I had the choice of going long on it or going short, I think I'd be more comfortable with a short position.
Yeah, and just looking, so the other one that floated a few years ago, which I think we maybe covered once, was it Porsche? Just having a look. I think that's got a market cap.
I think we may have covered Porsche.
I think we did once.
I don't know if I'd put Porsche in the same category because they make so many more of them.
Well, that's right.
They make more than 2 a year.
Well, that's it's much more of a mass production, and I mean that's almost been the key to its success. And I think not that we've covered really Ferrari, but I think that's one of the problems with Ferrari is that now they're becoming less exclusive, and the volumes have gone up a lot. That's more me watching YouTube videos and having Ferrari owners talking about the valuations.
Yeah, I think the results tell a different story.
So Porsche, they had their IPO back in 2022. It was about €82 or around €80 a share back then. Then it went up. I think it peaked in about 23, about €120 a share thereabouts. It's now down to about €45. Got a market cap of nearly €21 billion. But yeah, I'd sooner have shares in either Porsche or Ferrari. Yeah, well before Aston Martin.
Should we move on to another business that you'd probably own shares in before Aston Martin?
Yes, no, absolutely. So Haleon, Sam, how are they doing? This, for anyone who doesn't know, is the spin out of the consumer health division from Glaxo a couple of years back.
Yes, so we've covered them ever since they were spun out. So brands include Sensodyne toothpaste, Otrivin nasal spray, Panadol painkillers, and Centrum multivitamins. So it's those kind of brands. They have come out with their Q3 results, and revenue was 2.8 billion, which reflected organic growth of 3.4%. That was higher than the 3.2% that was expected. And this came from a fairly even mix of price and volume growth, with all regions contributing positively. All categories except respiratory health and therapeutic skin health were in positive territory, and oral health grew at 6.9%, which was helped by market share gains for Sensodyne and Parodontax. Around 1.1 billion has been returned to shareholders year to date through a combination of dividends and buybacks, and the recently downgraded guidance has been reiterated with organic revenue growth of 3.5% expected. Underlying operating profit growth is expected to land in the high single digits, however, mainly due to sort of cost cutting and getting the debt down. The shares were up 1.9% following the announcement of the results, and the results included better than expected performance in North America, double-digit growth in India, mid-single-digit growth in China, and they recently took full ownership of the Chinese distributor of the non-prescription medicines. Fairly limited impact from tariffs due to local production in the US and limited sourcing from China. And the net debt, they have been targeting 2.5 times underlying cash profit as they were spun out from Glaxo with what some may consider to be an unfair amount of the debt compared to what they actually maybe used. However, that's often the case with spin-outs, which we may well see with Airtel Money soon. They didn't comment because it was a trading update on the net debt to EBITDA ratio. I know they're targeting 2.5x. As of mid-2025, so when they did the last set of results, it was about 2.9x. So I don't know where it would be at the minute, maybe 2.7, something like that, but it will be getting pretty close to that target. In terms of the valuation, it trades at a forward P of 17.5. That compares to an average since listing of 17.8. God, listed in 2022. It doesn't feel like it's been 3 years. Anyway, prospective dividend yield 2.2%, and that compares to an average since listing of 1.9%. I think one thing that's interesting with this business, the forward PE is quite pricey, but although the revenue growth's not that great, as we've seen, there's been a lot of opportunity on the cost side, particularly in terms of getting the debt down as well. So that PE, forward PE at 17.5, I actually don't think it's that bad, considering they've probably still got more fat to trim than maybe Unilever has, or Reckitt Benckiser, or someone similar. I also think that prospective yield, 2.2%, it's lower than what we're used to from Reckitt and Unilever, but the management has quite rightly been focused on paying down the debt since they listed. I would expect that to go up once the debt is in the area they've been targeted. So yeah, I think the revenue growth, it's a bit disappointing, but I think in terms of the management since they've listed, I think they're doing an excellent job. That cost cutting, they're still seeing the benefits of it. And you're seeing that in the high single digit operating profit growth. And I think that could continue for a while to come, actually. So I actually think the valuation's pretty reasonable compared to what we've seen from Unilever and Reckitt. I know Reckitt had a decent set of results the other week, but I think Haleon's been more consistent since it was listed. So yeah, I think these are a pretty good set of results, even though the revenue was a bit disappointing. What about you, John?
Yeah, no, I would agree. I certainly don't think it was shoot the lights out performance, but chugging along there. I think for a consumer goods company that was spun out with a lot of debt, I guess getting on for 3 years ago now, it's been doing well. I think management have been doing a good job. In terms of as an investment, it's not the top consumer goods company as far as I would be concerned. I think there are better ones out there, and I'd probably at the moment be looking at more of Unilever and Nestle. I think Nestle's an interesting one in that it's historically and certainly over the last 5 years been very expensive, and that has pulled back a lot. So I would certainly be looking there before going into Haleon. But it's, that's not to detract from how management have been turning this business around since it's been spun out in quite difficult circumstances. And goods also, as we always remind listeners, that delighted that Unilever didn't proceed to buy Haleon. And I think they had offered 50 billion quid back in 2021, 2022 for the business. That didn't go through, which is fantastic, because I think that would have been massively overpaying for what I would consider lesser brands.
Should we move on to another business that's been managed well?
Yes, very well. So JD Wetherspoons, UK's largest pub chain. We've covered them quite a few times on the show before, led by their charismatic Tim Martin. They had their Q1 results out with full year revenue of £2.1 billion, reflecting like-for-like sales of 5.1% as previously guided. Underlying operating profit grew at a similar pace to £146.4 million, despite a fall in gross profit margins. Free cash flow increased by 71% to £56.6 million, helped by a reduction in interest payments. Net debt, including leases, rose slightly to £1.1 billion as increased payouts to shareholders offset better cash flow. First 9 weeks of the new year saw like-for-like sales growth of 3.2%, and the company expects a reasonable outcome for the year, but remains wary of the government-led cost increases. The dividend was held flat at 12 pence a share, and the shares were down nearly 3% in early trading. In terms of valuation, JD Wetherspoons has a market cap of £679 million and trades to 11.6 times forward earnings, compared with a 10-year average of 19.9, albeit we did have COVID in that period. And it has a prospective dividend yield of 1.8%. I thought these were good results. I think Tim Martin runs the business incredibly well. It's a great operator. However, it's probably in one of the most difficult sectors in the UK. It's taxed really hard, and it doesn't look like it's going to get any easier. They have the NI hike for employers earlier in the year, earlier in the year, back in April, and who knows what's going to happen at the upcoming budget. I think one of the bull cases seems to be that because you've got this huge property portfolio and the book value that, well, back 25 years ago when it was last valued was 1.1 billion, there's a case that if you liquidise the business, what would Wetherspoons actually be worth? It's not an investment case as far as I'm concerned. And I think you could be waiting a hell of a long time if you thought that the business was eventually going to be essentially liquidated. I think given all of the headwinds with the pub sector, I wouldn't be investing in Wetherspoons. And that argument for me, in terms of, I suppose, the value case for it, again, I don't think is particularly appealing. I get where people are coming from with it, but I think you could be waiting a hell of a long time, and I would just look elsewhere. Sam, what are your thoughts on the Q1 figures from Wetherspoons?
I agree. I think if you were going to base your valuation on a balance sheet that might not be realised for potentially decades to come, you would discount that very, very heavily. I think to the point where you're best just basing it on the earnings that the business is generating. I think the results were actually very good. However, they don't include the full impact of the last budget that we had, where the employment costs have gone up. So you do wonder what the next set will look like. They might be okay because we did have a really good summer. So that will probably maybe counter out some of the impacts. But yeah, it's not the best industry at the moment. I think at a forward PE at 11.6 is not awful, given sort of what a consistent performer it is, given how strong that balance sheet is. Even if it's not going to be realised, it's still an asset to the company. Yeah, I just think there's more attractive industries. So although it's a very good operator in a very tough industry, I'd just never touch it.
Okay. Now, on to PayPal. One of your favourites.
Absolutely. A business that I own. So PayPal have come out with their Q3 results, and net revenues were up 7% to $8.4 billion, and all these figures are in dollars. Operating income was up 9% to $1.5 billion. And the operating margin was up 33 basis points from 17.7 to 18.1%. The net income was up 24%. Earnings per diluted share was up 32% to $1.30. And the net cash provided by operating activities was up 22% to just under $2 billion. Free cash flow was up 19% to $1.7 billion. And adjusted free cash flow was up 48% to $2.279 billion. Total payment volume increased 8% to $458.1 billion, which was up 7% on an FX neutral basis. Payment transactions decreased 5% to 6.3 billion, excluding payment service provider transactions. Payment transactions increased 7%. Payment transactions per active account on a trailing 12-month basis decreased 6% to 57.6. Payment transactions per active account, excluding payment service provider transactions, increased 5%. Active accounts increased 1% to 438 million. And on a sequential basis, they increased by 0.1% or 0.3 million. The balance sheet has cash equivalents and investments of 14.4 billion at 30 September and debt totaling 11.4 billion. And the company returned 1.5 billion to stockholders in the quarter, and on a trailing 12-month basis returned 5.7 billion through share repurchases. And that is on a market cap of 64 billion. So it is a big percentage, which we have covered previously. And the board announced that they're going to start paying a quarterly dividend of 14 cents per share, and that will represent a targeted payout ratio of 10% of non-GAAP net income. I'm not thrilled about that because it means I'm going to have to pay 15% withholding tax in my ISA, which I wouldn't have had to pay if they carried on repurchasing shares. However, it is what it is. And the underlying earnings per share growth guidance has improved from 11 to 16% to 15 to 16%. So they're going to be at the upper end of their range. And separately, the company announced a partnership with OpenAI, where instant checkout with PayPal would soon be available within ChatGPT. In terms of the valuation, the business trades at a forward PE of 12.3, and that compares to a 10-year average of 27. And if you do a price to free cash flow, that's also around 12.3. So I think these are a good set of results. In terms of the valuation, I think it's pretty hard to argue with it. It's churning out cash. It's repaying shareholders, although I'm not thrilled about the form in which some of that repayment will come now. But yeah, on a value argument, I think it's hard to knock it. I think it's a high quality business. I think that shows in these results. I think there's still a lot of growth there. So yeah, I'm very happy with it. I continue to hold it. And yeah, I just think it's incredibly cheap for the quality of the business. John, as someone who's less biased and also pretty much entirely Apple Pay,
Yeah,
do you think?
I suppose that is the problem that I have with it, is that I used to use PayPal an awful lot, and then it's all basically switched over to Apple Pay. I would say if you took my family as an example, my sister probably did the same, my wife probably did the same, and that is a concern. And you do wonder, at what point does the music kind of stop for PayPal in that sense? I appreciate the figures that they've been putting up have been pretty good. I wonder, because the share price really hasn't responded to these figures, is the market seeing that Google Pay and Apple Pay are essentially sort of going to lead to the extinction of PayPal? And again, I appreciate we talk about stocks that are in structural decline and they can still do, potentially do quite well. But that is, what puts me off PayPal. I mean, the more times we cover it and the more times, the figures, they put up decent sets of figures, I do think, well, at what point does it change? But I haven't been brave enough to buy shares for the reasons that I just outlined. I mean, what do you think in terms of the share price, Sam? Why do you think the market takes such a negative view on PayPal?
I think probably, and to be honest, for the reasons you've outlined. Yeah, it's a weird one because the results are quite good, but then they've got some elements of the business that are actually performing quite well. They've got like Braintree, they've got Venmo. So they do have other parts that are faster growth. Some of these parts are smaller margin. But yeah, when you look at the whole kind of infrastructure that they've got and the whole web of businesses, it's not just the PayPal brand, although the PayPal brand is obviously massive. But there's not really anything coming through really that's that concerning yet. The return of cash is so high in terms of the buybacks that even if it lasts for a few more years, you could still have got a decent sort of chunk of your money back. I suppose you wouldn't, because it's as long as the share price hasn't tanked. But yes, I just think it's still a really high quality business. I don't think it's really, I think for online shopping, I think it still has quite a big role. I think a lot of people still use it. I do like to use it for my online shopping, mainly just because if I'm buying something that's maybe smaller value, where I'm not getting that protection from a credit card, I like to just put it on a debit card and do it through PayPal, because PayPal gives you an extra layer of protection as a consumer. So for online purchases, I do still use it a lot, and that's not just because I own it. It's because I do find it genuinely useful.
Yeah, fair enough. Would you be adding to it?
No, I'm very happy with the position I've got. It's not my biggest position, but it's a fairly reasonable size. If I turn out to be wrong on it, I'm pretty comfortable with it. But I think it's of a size where if I turn out to be right on it, I think I'll do well enough on it. So yeah, I'm very happy with the position as it is.
Fair enough. Well, on that, what would be your top pick and what would be last of the companies this week?
Ooh. So I won't be adding to this because purely for the reason that it is already my biggest position, partly because of how well it's performed. But I do actually think at a PE, and I appreciate this isn't the actual PE you'll see if you go on websites, but if you just take those half-year results and double the earnings, you get a PE of 20 for Airtel Africa. And I think that's pretty reasonable. And I do think there's an argument that once Airtel Money's spun out, it could trade at the valuation that the whole thing's currently trading at, because I think Airtel Money probably does deserve a higher multiple just because of the type of business it is. Least favourite, it's got to be Aston Martin. There's not really any decision to be made there. It's just uninvestable. What about you?
Yeah, no, I would probably go for Airtel as my top pick, and Aston Martin would be last. It's quite an easy one.
Right, I think that's everything in that case.
Thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.